Welcome to Lucas Invests, making money simple. Hi, before watching the video, click the subscribe button.
There is a massive ticking time bomb hidden deep inside the global financial system right now. It's not the stock market, and it's not real estate. It is the private credit market. Right now, 30-year U.S. Treasury yields are hitting levels we haven't seen since 2007, and global borrowing costs are skyrocketing. A catastrophic wave of defaults is coming, and Wall Street is using dirty accounting tricks to hide it from you. To understand why this is going to collapse, you have to understand how these companies borrow money. Almost all the debt in the private credit market is based on floating rates tied to something called SOFR. Back in 2022, SOFR was essentially at 0%. Money was completely free. But today, that same rate has exploded to over 5% and has stayed there. Imagine taking out a massive mortgage where your monthly payment suddenly triples overnight. That is exactly what is happening to thousands of companies. They are completely suffocating under the weight of these massive new interest payments. When a company can't pay its interest, it should default, right? The system should clear out the bad businesses. But Wall Street doesn't want to admit they made bad loans. So they use a brilliant, evil accounting trick called PIK, payment in kind. Here is how the PIK illusion works. When a company doesn't have the cash to pay its monthly interest, the lender says, "Don't worry about it. Just add that missed payment to your total loan balance." The debt isn't officially marked as a default. On paper, everything looks perfect. But in reality, the company's debt is growing larger and larger, like a snowball rolling down a mountain. Currently, a shocking 11 to 12% of the entire private credit market is surviving strictly on this fake, imaginary PIK accounting. It is a house of cards. And here is where the math completely breaks. Many of these private credit funds operate as BDCs, or business development companies. By law, BDCs must pay out 90% of their income to investors as dividends. Do you see the problem yet? These funds are counting that fake payment in kind interest as actual income. They haven't received a single dollar of real cash from the struggling companies, but they are still paying out hard cash dividends to their investors based on ghost money. This is bleeding the financial reserves of these funds entirely dry. Despite all these dirty tricks, the dam is already breaking. The default rate in the private credit market has just hit 6%, an all-time historical high. Look at massive companies like Pluralsight. They are proving that no matter how big you are, brutal interest rates will eventually destroy your business. But the real nightmare hasn't even started. Welcome to the maturity wall. Between the years 2026 and 2029, approximately $85 billion of this BDC debt expires. These zombie companies will be forced to renegotiate and refinance their debt. When they try to refinance, they won't get the magical 0% rates from 2022. They will be forced to refinance at today's brutal, elevated rates. They won't be able to afford it. It will trigger a massive wave of bankruptcies, wiping out billions in investor capital. The finance industry can use all the hidden accounting tricks they want to cover up their losses. But at the end of the day, you cannot cheat economic math. The systemic failures are bubbling to the surface, and it's going to get ugly. If you want to survive the financial storm that's coming, hit that subscribe button. I'll see you next time.